Nick, good morning. Thanks very much for joining us.
Thank you for having me.
I mean, it's all eyes on Greece, isn't it? This meeting with the IMF, the ECB and EU governments looks likely to be postponed until Wednesday, Nick. But are we edging closer to a position whereby Greece is actually going to take this money?
I think actually they're going to be forced to take this money. I mean, it's in their best interest to provide their citizens with some form of stability. But the real issue is that even though they do get this sort of financial lifeline, doesn't mean that they're out of the woods just yet. It just buys them some extra time. What really needs to be done is implement some strong austerity measures across the country. And even though it might not be politically popular, it's really what needs to happen.
But of course, stronger austerity measures, Nick, could mean a stronger recession.
It could be, but you know what? Sometimes you need to take your pain. And unfortunately, that's what Greece, as well as many other developed nations, need to encounter. It's almost like we need to take a page out of the Swedish book. You know, they ran some major deficits in the early 90s. They were able to turn things around rather quickly. The key ingredients there were they were able to accelerate growth and cut government spending quite aggressively. So certainly Greece, Spain, the UK, and the US, to name a few, can easily follow suit.
What does your outlook then mean for the European government bond market right now then, Nick?
We would certainly be more focused on Germany and France, underweight the peripherals, because there is that uncertainty that's out there. Sure, when the lifeline does get extended to Greece, eventually it may get extended to the likes of Spain and Portugal. But again, the uncertainty that's out there certainly doesn't help matters from an investing perspective. So I would err on the side of caution and focus more on German government debt and French government debt.
The story that's almost superseded Greece in importance, Nick, is, of course, the Goldman Sachs one, which broke on Friday. We're seeing money flood into the safe haven that is fixed income debt right now. Do you expect that to continue? How's this going to play out in global financial markets?
Look, I don't think the Goldman issue has materially changed our view on economic conditions going forward. The economy is on much better footing, but that said, they are in the infancy stages. We've had positive job growth. Corporations are deleveraging. They're starting to turn our profit. It's almost like we've seen a checkmark recovery as opposed to a V-shaped recovery or W-shaped recovery. But that said, the market will be faced with a series of aftershocks that will jolt the market. So investors need to be cognizant of the fact that the road to recovery is not going to be smooth. And whether it's, mounting government deficits or SEC violations or investigations, it does going to create a lot more uncertainty in the marketplace.
And that means that maybe we should be casting our spotlight less on developed markets and onto the emerging markets. Is that the answer?
Absolutely. And I would actually consider, countries in the Asian region most particularly. Things are going great in Australia as well as other parts of Asia, ex-Japan most notably. They run very strong fiscal and monetary policy. Yields are quite attractive in this region. Our portfolio, for example, is sitting roughly about 80 to 85% invested in this region. So investors are being compensated for not taking on that much risk by being in this region, most notably.
So how specifically do we wager this bet then on the region then, Nick?
Look, I don't expect the Asian region to carry the global financial world out of this crisis or on the road to recovery. We're not quite there yet because it isn't as big. So sooner or later, we are going to see need to see some sort of economic growth from the U.S., the U.K., and Europe. But certainly, the Asian region can lead that.
And I mean, so you are confident that a sort of a global rebalancing will happen, but it might take a while for it to actually materialize.
It's going to take a long while. I mean, look at the U.S., for example. Again, they have a mounting deficit that really just seems insurmountable, to be perfectly honest. So they're going to have to cut government spending quite aggressively. And that also means that in order to accelerate GDP growth, they're going to have to keep monetary policy very, very loose in order so that consumers can actually go out and spend, and they're not worried about facing rising interest rates, whether it be in the mortgage sector or even in the Treasury sector.
Okay, Nick, thanks for joining us. Speak to you soon. Nick Maroutsos there live from Sydney from Kapstream Capital.